Jordan, good to see you. An important topic today, 6 critical risks that could derail your retirement. When it comes to retirement planning, it's not just about saving enough, it's about preparing for the risks that could undo all your hard work. So we're going to break down the top 6. Number 1 is sequence risk. What is this?
Yeah, this is when you just retire and you need to take withdrawals from your investment accounts. If the market takes a dip, that could derail, as you mentioned earlier, your retirement plans. Because when the market dips and then you're forced to sell at a loss potentially, that's called sequence of return risk. Now, when you're working in your accumulation years, you don't face this because market's up and down. It doesn't matter because you're not taking distributions. But once you start taking distributions, you have to be aware of this and be proactive on this. So the money that you might need for the next 3 to 4 years isn't at high risk or any risk. So if the market dips, you don't have to ever be forced to sell at a loss.
Right. Special note to everyone who's in or near retirement right now as we are in a down market. All right. Risk number 2, withdrawal rate risk. I mean, we've heard of the 4% rule. Is this kind of what we're talking about?
Yeah, some people have generally said, oh, take 4% of your nest egg, and then that'll last you 30 years in retirement. That may or may not be true, because if all your money is at risk, like our previous scenario, and you take money out as the market goes down, that could actually derail and accelerate that. So what we like to do is create a plan to make sure that no matter what happens, you're never going to run out of money. You have money aligned to the purpose. So not all your money is tied to the stock market. Not all your money is in checking and savings, but you have money designed for safety, income, and growth, and to make sure that you can withdraw safely from your portfolio without added risk.
Next, we have to talk about what could be one of your biggest expenses in retirement. That is healthcare, and also more specifically, long-term care, which 7 out of 10 people will need at some point in retirement. And if you don't have a plan for this, take a look at these annual expenses projected out to like 2043, Jordan, anywhere from $124,000 to $211,000.
Yeah. Healthcare is rising at a rapid rate. So now we want to be proactive and do some planning. So if you're still working and you have a high deductible insurance plan, you want to start doing HSAs. You get the tax deduction, you get the tax deferred growth, and then you can take it out tax-free for healthcare costs, whether that be for Medicare or that might be for future long-term care. But also long-term care, we got a plan for, because as we mentioned in the opening, we don't want to derail all the hard work for decades because you're in an extended long-term care facility. So we can look at alternatives or different things inside your plan. How do we prepare for that and stress test your plan? One thing I like to people to think differently on is the next 2 words I say, which is life insurance. Because the new life insurance, they can get a death benefit that transfers tax-free to their beneficiaries. But if they get sick while they're still living, they can use that death benefit while they're still alive to pay for these long-term care claims or these services. And it's a great way to get 2 benefits in one policy, and that could potentially leverage your future long-term care costs.
Interesting. All right. Next, we have taxation, which is so important.
Yeah, taxes might be the big expense for many people in retirement. And without knowing you, I know the majority of you that are near or in retirement have most of your assets in 401ks and IRAs.
Right.
And that money has not been taxed yet. So you need to have a plan around taxation. We have our retirement roadmap, our safe and secure retirement roadmap that kind of looks at all 5 major of these financial pillars. But you can see dead center in the middle there is tax planning. Because every investment decision has a direct tax implication. And when you look at taxes, you don't want to look at just this year or last year when you prepare your taxes. You want to look at the next 5, 10, 15 years. Where are taxes going to be, and where are you going to be positioned to pay the least amount of taxes? Now, Aaron, I'll ask you a direct question. Your personal opinion, do you think in 10 years taxes will be higher or lower?
Considering we are living in a historically low rate, I'm going to guess they're going to be higher.
I would agree with you. And I think 99% of the people I talk to agree with that same conviction. So we got to pay taxes now while taxes are sort of on sale versus wait to the future and get blindsided by extra tax rates.
And now we have to talk about the silent thief in the night, inflation.
Yeah, inflation's there. We don't see it. And just like the wind, we don't see it, but we can feel the effects when it blows on a tree or something like that. Inflation is eroding at our purchasing power, because whatever we have in our nest egg today, 5, 10 years from now is not going to give us the same purchasing power as it did right now. So in all of the plans we create for our clients, we want to incorporate inflation into that because we know it's there, it's out there, and we got to not only just maintain to keep up with inflation, but we have to outpace inflation and make sure you keep that purchasing power so that's 100% factored into everything we do when it comes to the plan.
Mm-hmm. And then last, we have to talk about the risk multiplier, longevity.
Yeah, the good news, Aaron, is we're living longer.
Mm-hmm.
The bad news is we're living longer,
Mm-hmm.
right? And we got to make sure our assets last us for the duration of our lifetime. So we want to create a plan where our clients are not concerned or worried about running out of money. They know with confidence and clarity they'll never run out of money. They know that the plan's going to sustain them no matter what happens with the markets, inflation, healthcare, and make sure we prepare for that longevity because the healthcare is getting better in some ways and people are living longer. So we got to ensure those assets last in their lifetime.
Right, absolutely. You know what's great to talk this through, Jordan? These risks, you live in this world, so you have a plan to accommodate, account for all these risks. Whereas I think a lot of people might not necessarily take inflation into account, which can be really scary. So if somebody wants to talk through, again, these strategies and these risks, what's the best way to reach you?
Yeah, many people have these concerns, these worries, these major problems, and they think it's big for them. But this is what we solve on a day-to-day basis.
Right.
And we know we can give them confidence and clarity if they want our help. So if they want to start that journey and have that first consultation and just conversation, they can call our main number, 847-499-3454.
Great. And then just a reminder to everybody that we will have a QR code here at the end. Jordan, thank you so much for your time today.
Thanks, Aaron.